Hello guys, can you hear me?
Yes.
Okay, so I'm starting the workshop now, and I'll be talking about mainly IFRS topics, IFRS 17. IFRS 17 is equivalent to IFRS 9 in banking sector. So it does the same job which IFRS 9 does in banking, same thing it does in insurance sector. It's more to do with accounting standard. Like we have accounting standard in banking, and we moved from those standard to IFRS 9. Same way, we have moved from IFRS 4 in insurance sector to IFRS 17. This standard has evolved over last 10 years, and after journey of nearly 10 to 15 years, we are here. We are implementing IFRS 17. So let me go into the slide. So we discuss about the approaches which are related with IFRS 17, scheme approach, PA approach, VFA approach. This presentation is based on the papers from Actuary Society and IFRS Foundation.
Nitin, I think we don't see your screen yet.
Sorry about it. 1 minute, let me do it again. Can you see now?
Yes, yeah, we can.
Okay. So we will discuss about the three approach which IFRS 17 has, GMM, PA, VFA. And this presentation is based on the paper of Actuary Society and IFRS Foundation. So this company which I'm representing is Infigo Software Solution based out of Dublin. Let's talk about abbreviations. There are different abbreviations which you'll use during this particular presentation. AOC, analysis of change, building block approach, BBA, past estimate liability, PAL, BOP, beginning of period, start of accountant, COA, cost of capital, COC, contractor service margin. Before we get into there, let's look at some of the key definitions which are related with insurance sector, which are there on. Let me take you there. So it's okay if you don't have background in insurance, but still you'll be able to understand it because we are doing it from the scratch. So these are the key terms. When you go to the insurance company, they sell you insurance policy. For you, it's insurance policy. So for them, it's insurance contract. So these are the key terms which are related with IFRS 17 with the insurance policy or insurance contract. One is coverage period. This is the time period under which insurance policy service will be provided. And then we have insurance risk. Insurance risk is the risk basically which is transferred by policy holders to you as an insurance company. Then we have different components like insurance contract. Insurance contract is an agreement between customer and the insurance company. Through this contract, the insurance company transfer the risk, sorry, policy holder transfer the risk to the insurance company. Then we have contractor service margin. Contractor service margin is it's a profit which insurance company is about to book but not booked yet. which means as the service provided, the profit gets booked over the coverage period. Fulfillment cash flow. Fulfillment cash flow is the cash flow related with premium, related with claims, related with benefits, related with expense, any adjustment with the timing and the risk of this amount. Some of the insurance policy are not just insurance policy, they have investment component. That component is related with the, they will take money from you, they will invest in some portfolio. That portfolio will give you handsome return, like a policy in India by ICI called ProLink. ProLink means it's unit linked. So as you pay, you get some assigned units. And those units basically are invested in market and you get some return. So that's what it's called investment component. When you have more than one insurance contract together, they're called portfolio. Portfolio means it could be for motor insurance, it could be for health insurance, it could be for life insurance, etc. Then there are two terms related with IFRS 17. Liability of incurred claim. It's a liability related with claims which has happened already. Liability for remaining coverage. This is related with the liability which basically is related with the future cash flow. And there are additional two terms. Policy holder, the customer. Risk adjustment. It's a bonus which insurance company keeps if risk pays off. If risk doesn't pay off, I think it goes in compensating the losses. So these are the key terms for the IFRS 17. I think this is there on our company website. So let me go back here again. So I talked about CSM, contracting service margin. It's a profit. Then I talked about end of period, GMM, general model, fulfillment cash flow. It's a cash flow related with the best estimation of liability, contract service margin, and risk adjustment. Three cash flow together, they basically form the fulfillment cash flow. Then there are three approach to do the migration from IFRS 4 to IFRS 17. Fully retrospective approach, where basically you do as IFRS 17 has been always implemented. The second approach is related with the fair value approach. When you don't have much data available, then you go with the fair value approach for IFRS 17 migration. Modified retrospective application is related with the, it's between fully retrospective approach and fair value approach, which means you have some data, you don't have all the data for the past. Then other comprehensive income is related with the profit and loss statement. And PA is one of the approach. Risk adjustment is bonus for carrying the risk. Risk margin comes from the Solvency II. Solvency II is the risk management standard like you have Basel in banking. Same way we have Solvency II, and there are two kind of capital, minimum capital ratio and significant capital ratio. So you should have minimum capital to deal with the risk, and you should be having at least 45% of the significant capital to minimize the risk. Transition work group, resource group, basically this is a group which is which is basically leading the standard of IFRS 17. UOA is a unit of account. Then we have variable fee approach. Then we have year end. So, any question? Anyone?
As of now, no, Nitin.
Sorry,
As of now, no questions. Thanks.
no problem. So let's look at the background of the standard. So the background of the standard is like we have IFRS 4 issued in 2004, and then it was implemented in 2005. And then in May 2007, discussion paper started coming like the standard is not sufficient, there are some problems. And then there's some proposal in 2010. In 2013, there's another proposal which has been revised. In 2017, they issued IFRS 17 new standard, and they expected to implement it by 2021. So why we are moving from IFRS 4 to IFRS 17? This is a big question. So there is a lack of compatibility between country in the profit and loss statement and balance sheet. 1 minute. So there is a lack of compatibility between countries, lack of compatibility between companies, and there are different level of safety embedded in insurance collaborating in calculation. And then there is a valuation of 1 minute. I think somebody else is joining. So other thing was discounting was sometime applied, sometime it was not applied. So there are 5 to 6 things which are mainly region 4, IFRS 4, not to be compatible in the sense that people can do with company can do business with each other, and they can expect that you have followed the same standard in profit and loss calculation and balance sheet calculation which other company has. So it was difficult to do merger and acquisition. It was difficult to judge the value of company from country to country. So those are the kind of main issue which we have with IFRS 4.
Nitin, I think the
So
screen sharing is still gone. Maybe
sorry,
the screen sharing is not there. So maybe it's just for me.
sorry. 1 minute. I don't know how it happened. 1 minute. Our screen sharing disappeared. So talking about the problems with the IFRS 4. So main problem with IFRS 4 was like if you go from one company to another company, it was not possible to compare the balance sheet and profit and loss statement. Same thing when you go from one country to another country, you could not compare the two things, which basically could help in doing company acquisition or comparing the company in the stock market or doing the merger and acquisition. Sometimes discounting was applied, like in UK and Europe, discounting was applied. But when you look at the country like India, Indonesia, Malaysia, etc., discounting was not applied in calculation. So insurance insurance liability were calculated based on the historical assumption. So why we go for IFRS 17? So there will be consistent accounting for insurance contract for all companies. Estimate will be used based on the current market data. Then discount rate will reflect the cash flow characteristic. It's not going to be based on economic risk or something like that. The measurement of contract will reflect the time value when significant. Measurement will be based on the current data, which means you will know what is the exact profit and what is actually loss. It won't be like there'll be confusion based on the balance sheet and profit and loss. Any question? So what is the scope of IFRS 17? The scope of IFRS 17 is it replaces the IFRS 4. It will change the business model significantly for different insurance companies because they will not be able to book the profit. They used to book profit without discount, and they were claiming they have profit in the first year, but after first year, second year onward, they have less profit. So those situations will not happen. It is expected that it will be implemented in EU by 2023, and in other countries there are 2-year relaxation. There are three approaches which I had discussed: fully retrospective, modified retrospective, and then fair value approach. So depending upon the availability of data, you will implement that particular model. Like fair value is more to do with if you have to sell that particular insurance contract, at what value you're going to sell it. That's fair value. So let's discuss the comparison with respect to Solvency II and IFRS 4. IFRS 4 is like you have reserve. Reserve is basically set of cash flow of premium which is going to happen. If you're going to collect the premium over next 10 years, you will say that this is my reserve, and you cut down the cost of the acquisition. The rest of the thing will be reserve, like a reserve for you, which will look very good in first year, but rest of the year it will basically look less value. Then we have risk management framework, which is called Solvency II. In the risk management framework, we have risk margin and best estimation of liability. So this particular thing had been leveraged here, but calculations are different. And the risk margin has been also leveraged, which has become risk adjustment. But again, calculations are different. And then we have contract service margin, which basically is more like you keep the profit there. You will not declare that in the profit and loss and balance sheet fully. You will declare only that percentage which you basically have provided a service for. Any question? So the scope is with the insurance contract, reinsurance contract, reinsurance contract issued and held, sold and acquired, and insurance contract with the participation feature, where you have basically unit linked service, where you take the money from the customer and you provide insurance service, plus you invest his money into the stock or mutual funds and basically give some return to the customer on a regular basis, and you charge annual maintenance fee. So those are the kind of insurance contract which are in the scope. You want to make sure that there is insurance risk, otherwise it will not be in IFRS 17 scope. So insurance risk is basically this is a possible probability that you're going to make loss, and you're going to assess that loss on present value basis. It's not just like where basically you done some calculation and you don't know what actually has happened in balance sheet, what has actually happened in the profit and loss. So going to calculate there's a possibility of loss, and that loss will be tracked. So this is a kind of contract, insurance contract, which are part of the IFRS 17. Any question? So there are three approaches which basically are there in IFRS 17: premium allocation approach, building block approach, variable fee approach. So premium allocation approach is for short-term contract, or it can apply for the contract which basically are general contract, but they don't differ in calculation much from the building block approach. If they are more than 1 year, normally it's for 1 year, the premium allocation approach. Building block approach is for long-term business, life insurance, term insurance, protection business, annuity contract, reinsurance contract, etc. Variable fee approach is for unique linked up contract, like I mentioned, where you're going to invest, or variable annuity, or continental European 1910 contract, or UK profit contract, or unitized profit. So these are different kind of approach which basically are available under IFRS 17. So let's go bit deep into building block approach. The building block approach, these are the principles and these are the blocks. There are 4 blocks. Block 1 is to do with the cash flow, which means calculation of liability, expected cash flow. So you have cash flow related with premium, you have cash flow related with claims, you have cash flow related with expense, you have acquisition cost. So all those costs are there as a part of the future cash flow. And then you had time value adjustment. With the time value adjustment, you will have cash flow which will be discounted. And then there is a bonus for carrying the risk of insurance. That's called risk adjustment. And then there is a contract service margin, which basically is a profit which you book as you provide the service. It is clear? So these are the 4 key blocks in the GMM approach. All the rocket science is all about calculation of these blocks and report them. You sum these 3 blocks, block 4, block 3, and block 1. It will give the total contract liability, and the total contract liability is part of the balance sheet. So look at the principle. So we basically use the current estimate assumption. Contracts are grouped by portfolio, year of sale, or 3 outcome of the profitability: loss making, profitable, non-loss making. 3 types of them. There is something called insurance coverage service, which I have described. A coverage is the unit of service which you provide during each year or each quarter. And profits are deferred by using the contract service margin, and they are released only when service is provided. There is a discount rate which is based on currency, duration, and liquidity. That discount rate basically helps to get the time value of money. Any expected profit from the participating contract revalued based on the asset. This is basically has to do with the variable fee approach. Any question? So let's talk about coverage period. So coverage start when your first payment is due from the policyholder or actually received. Or second point, it can start the coverage when basically contract become onerous. Contract is loss making, you immediately recognize that in profit and loss statement, and it be basically vulnerable. Anybody, any question? So there's something called contract boundary. So insurance contract has a boundary. Service has to be provided within those boundaries. So there are conditions like the policy holder has to pay the premium if within contract boundary. If you basically able to reprice the risk, then it's outside the contract boundary. Practical ability to reprice the portfolio contract, that is also outside the contract boundary. Premium reflect the risk during the coverage period. Yes. So your coverage period is 1 year, and you might have basically time where your incident happen or accident happen, and you claim it by after the insurance policy basically expired, and you have 1 year period during which you need to get the settlement of the premium, the claims. So there are 4 different criteria for defining the contract boundary. So are you guys with me?
Yes.
Okay,
Yes, Nitin.
okay, good. So there are cash flow which are related with the building block approach. So those cash flows are related with premium, related with claims, related with option and guarantees, related with cost of selling, underwriting, initiating, that can be directly attributed to portfolio level. So when you sell the insurance contract, there there are some costs which is called acquisition cost, and there's some costs which are called renewal costs. So those costs are part of the cash flow. Taxes, policy administration and maintenance, that's also part of the cash flow. And there are some overhead related with the claim software, etc. That's also part of the cash flow. What is not part of the cash flow? Investment returns, payment to and from insurance, cash flow that may arise from the future insurance contract. So something which is not related with the current contract are outside the scope of the cash flow. In the case of variable fee, when money comes from the mutual fund or any other investment or option or hedging, that also is outside the scope of the cash flow. So let's talk about the second block of the building block approach. So building block approach, second block is discount rate. Let me talk 1 minute. Guys, you are following it?
Yes.
Okay.
Frankly speaking, Nitin, I'm from the credit risk and market risk background. I haven't worked on the insurance side. Trying to digest the regulation part, but if you explain, uh, I mean,
You
how
can ask.
practically that implement or any problem.
Okay. I will do that. I'll just show what basically is practical thing here, and
Okay.
then I think it will be better
Okay.
because because
Thank you. And also, can you please explain us the objective of this, like after?
yeah, sure. The objective is like what I'm doing is I'm building a software related with IFRS 17. Okay,
Okay.
and that software, when I'm building that software, I'm finding that there's a huge opportunity in this particular domain,
Okay.
which means which means like you're implementing IFRS 9,
Mm-hmm.
same way IFRS 17 implementation is going on.
Okay.
And when it comes to the people like me or you, there's a big opportunity in terms of making a lot of money.
Okay.
In the sense that software is costing like millions, and
Mm-hmm.
implementation is also costing millions to the insurance company. So you can believe what kind of money is being spent by insurance company to implement this standard.
Okay.
Okay. So let me go to the Excel sheet, which basically I have prepared after a lot of research. So we will have data like this: sum insured, policy issued, prime rate, premium rate, how much premium rate is basically, it's probability weighted. So this is the probability of payment for premium, and policy fee is like this. This is the fee. This is the commission. This is acquisition commission. This is renewal commission. This is the expense which are attributable to acquisition. This is expense which is not attributable to acquisition. This is maintenance expense. This is maintenance expense which is non-attributable. Premium tax, which is zero. Chargeback is zero. Investment income tax is zero because this is not an investment contract. Discount rate, asset earned rate, which basically is more like you have put something there in terms of capital and how much interest you are going to get. This is locked in CSM rate. This is how many people are going to drop out from the policy. What is the death rate, and what is the death rate declaration? What is mortality adjustment? So this is the assumption which I have made in this particular insurance contract, insurance policies. I have 1,000 policy, and this is the sum which basically I have basically insured. If you go here, so I'm going to do the calculation of expected cash flow, actual cash flow. Actual cash flow will come from the customer, and then I will have coverage unit. Coverage unit means how many units of the coverage I had. I had 1,000 policies. So initially, I basically had 1,000 policies, and then I had death, then I had lapse, then I had closing. So this particular thing is coming from this table, 1,000. This bit is coming from here. This bit is coming from here. So initially, I had 1,000 policy. I'm left with approximately 950 policy. at the end of the first year. This 950 policy becomes the closing opening balance for the next year, and I'm left with 902 policy. At the end of duration, I will have 96 policy in the beginning and 0 policy, which basically is the rest of the policy basically get mature at the end of 20th year. Are
20th
you
month
follow?
or 20th year?
20th year. It's 20-year
Okay.
policy. It's life
Okay.
insurance.
Okay.
So based on this, I will calculate my premiums. There are certain formulas which you apply to calculate the premium, how much premium basically I'm going to get out of 1,000 contracts. Are you with me?
Yes, Nitin.
So here I have this amount multiplied by this. This is per 1,000. It will be 140. 0.7 basically is for per 1,000. 0.7, so it will be 140 plus 65. It will become 205. Then multiply by 1,000. So I will have 205,000 as a premium here. So these are just application of the formula here. Then I have acquisition commission. Acquisition commission will be 80%. It's 80% of F7. F7 into F5. This
What is
amount,
F7 in data life insurance tax
F7 is this,
commission?
80%. Yeah. This is
And
my
what is the meaning of lapse, Nitin?
lapse means you join an insurance policy after 1 year or within a 1 year, what percentage of insurance policy people basically back out from the insurance policy? Either they take their money back or they basically stop paying.
Okay.
So this is my acquisition commission. This is my acquisition attributable expense, the maintenance expense, and then this is non-attributable expense. This is a non-attributable expense. This is my value of claim. This value of claims comes from this amount, this amount multiplied by sum assured. Sum assured is F34, F34, F34 is this. This amount multiplied by sum, which is what is the sum assured. So if you multiply by sum assured, multiply by death, it will give me how many claims are going to come to me. Is that okay?
Yes.
Okay. So to sum this all up, it comes this much, this amount. So in the next year, we use the same formula, but this acquisition expense commission is 0 because acquisition happen only once. After that, there is a renewal commission. Make sense?
Yeah.
So renewal commission is this, and so all these are formulas here. So you calculate the cash flow.
Nitin, can you please clarify me one point that see, this is the current premium 25000 that I can see in the positive, but total net CFS I see it in a negative because acquisition commission they're all coming.
These
How can I
all
interpret this total and net CFS?
thing is, it's a sum of this up to here.
Mm-hmm.
In the first year, it will be negative. Normally, when you take the insurance policy, the agent takes up to 70 to 80% commission.
Okay.
So this is why it's negative. In the second year, it becomes positive. And if contract is loss making, which means insurance has loss, then it might be net is negative. Net means present value of the cash flow.
So that is for insurance company, right? Positive or negative, that will check
Yeah.
by the insurance company, right?
Yes. 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 Thing is, we have expected data, but we don't have the actual data. Because of that, we have put equivalent to this. Everything is equivalent to this one.
Okay.
Then there is something called risk adjustment. So you need to make the assumption about the risk adjustment. What is the risk adjustment value? We have made assumption about the risk adjustment that is 10% of the claims. So 10% of the claims means this value multiplied by 10% of it, it becomes 8,000. Is this okay?
Yeah.
So coverage unit, expected cash flow, actual cash flow, and then we have best estimation of liability. So before we go into there, we will calculate the present value of our cash flow, premium, renewal commission, expense attributable, and then claims, present value of acquisition, which is attributable, and then risk adjustment. We sum this value. This value is coming as positive, which means by the calculation of premium value, present value of all cash flow, we are heading towards positive value. All these are present values which are in the cash flow. So we are getting this value, which means we are positive. We are positive. We basically have profit to book. We don't book profit in the first year itself. We assign that profit to CSM. So that liability on the initial recognition is 0. So there are 3 tables which you calculate: BEL, risk adjustment, and CSM. In the BEL, we will have value related with new business, which will basically sum up from here to here. Claims, attributable, commission, premium. All this cash flow will come here as a sum. All these signs are provided by Actuary Society, and I cannot really comment why this is positive, why this is negative. Is that okay?
Okay, Nitin. And I have one more question, Nitin. By doing this exercise, what insurance company understand about? I mean, you are saying somewhere it's items related to the liability and items related to the assets. So, will they? What is the objective by doing that exercise?
I'm showing you.
Okay.
They basically define certain standards. So they used to have income statements like this, like cash based on include deposits. So when you're including deposits inside the premiums calculation, it used to create confusion. And the repayment of deposit is part of the expense. So there were too many confusing items in the income statement, too many confusing items in the balance sheet. So what they want to do is they want to clean this up, and they want to come up with the standard where they are in line with the industry, other industry, like banking industry. When you look at the income statement of the banking industry, they will not have this kind of confusion which they have mentioned here. Make sense?
Yes, Nitin.
Okay. So they have come up with new format of income statement where they have insurance revenue, where they have insurance expense, and these are the values here: insurance service result, net financial result, and this is the profit. And
Okay.
then balance sheet is again changed. It is have asset, reinsurance asset, and liability will have insurance liability, and this is the liability. So in our case, when you look at this table, I will have these three calculations: BEL, risk adjustment, contract service margin. If I sum these three table up, I will get a total contract liability, which basically is used here in this calculation, this one. So idea is to simplify the calculation, but it's so complicated when I start working on this that it created more confusion in my mind. But I have followed the rule which they have provided. Is
So
that
what
okay?
rule they have provided? I mean, before in slides, whatever the points that you have discussed.
Yeah, these are the kind of points they have provided. They have main problems with the. I'll come back to the original slide. These are the main problem which they have with IFRS 4.
Okay.
Yeah. People please ask question because it becomes very difficult to teach if basically people don't ask question. Even others can ask question. Others, you there?
Yes, Nitin. I have one more question, Nitin. So how you converted this as a software? I mean, what you said, you have implemented or developed some software. So by using that software, then how insurance company will get benefit or will get time save by doing this or utilizing your software?
Okay. I will show you the demo first. So I have put some assured here, number of policy here, premium rate here, policy fee here, initial commission here, yearly commission here, acquisition direct expense, indirect expense, main direct expense. So all the values which I have utilized in my calculation, I have put here, which I can tweak anytime. Like if I have to tweak like this value to 6, I can tweak it. And then I can say calculate everything for me. I'll just say calculate. So what it does, it basically take these values here, like we had take it to 0.06 mortality. So this is 0.06. So it will calculate the coverage unit for IFRS 17 and IFRS 4, so that you can compare. And then IFRS 17 expected cash flow, IFRS 4 cash flow. So these calculations are happening here. You just saw that table liability of initial recognition. This is liability of initial recognition according to IFRS 4. Both the tables are similar. The only difference is there is no discounting applied in IFRS 4.
But
Okay.
in IFRS 17, is that discounting applied? So
Yes.
if it is applied, and where is that number differentiation that we can see in this two?
Thing is, you have to see this particular value and this value,
Okay.
this value and this value. So these have too many values. It has few values because IFRS 4 was simple. But because of the lack of compatibility between different companies, different industries, and different countries,
Different regions.
different regions, it was rejected. Then we have BEL here, which basically I was telling you. This is a BEL according to IFRS 4. And this is the reconciliation of risk adjustment, which basically part of only IFRS 17. Risk adjustment is more like a bonus for carrying the risk. Then we have CSM, which basically is like a profit, which basically you are going to keep on hold until service is provided. So this is the amount of profit you have, which you will discharge every year as the service is provided. Make sense?
Yeah, suppose uh, imagine that I am an insurance company. So earlier I'm following certain rules or whatever the IFRS 4. So after utilizing this tool or dashboard which you created, uh, so I can record what are the points that I can record in my balance sheet. You have shown before, right? So here I have multiple rows or multiple parts that we calculated. Let's take remaining coverage or total contract liability. So
So
in
this
that,
is this total contract liability is part of my balance sheet, which means
Mhm,
if I go here in insurance contract liability,
mhm.
I will put these values.
Okay,
Thing is, there are two kind of insurance you have. One is insurance you basically are giving to the end customer. Then you take insurance from other company against that insurance that I don't want to take so much risk. Can you insure me? That is called reinsurance. So when you take reinsurance, so you will have some kind of asset, some kind of liability. So that kind of thing is entered here. When you take insurance from other companies, it become an asset. When you give insurance to other somebody else, it become a liability. So that's why these signs are different than what you think is normal sign.
okay,
So what this tool does is it can do this. Other thing is you have individual contract data. I'll show you the data. 1 minute. So this is individual policies with this data. And this is part of
okay,
the portfolio ABC. And I had two portfolio, ABC and XYZ. I had nearly 824 individual policies. So the calculation which I had just shown you here,
in
it
dashboard.
basically deal with the 1,000 policies. But this is aggregated data.
Mhm.
And what you see here is individual
Individual data.
policies, individual data. So we can work with the individual data also. We will upload that. It will take some time to process. Let me get into the here where I explain you more here. So I have told you about the risk adjustment. I have told you about the best estimation of liability. So based on this table, these three tables, BEL, risk adjustment, and CSM is populated. And we use some values from here from the expected cash flow and acquisition cash, actual cash flow. So if you get it right here, at the end of day, your liability should become zero, your risk adjustment should become zero, and your CSM should become zero. Because whatever value you have of the liability, that liability over the time should become zero. You cannot have liability, otherwise it will show as a loss in the balance sheet and profit and loss statement. So I was telling you about the total contract liability. So if I go here, reinsurance which I had taken is an asset, insurance which I have given is a liability. Difference of this particular asset and liability is my equity. If you understand it, it's very simple. If you don't understand it, it's very complicated. Got it?
Yes, Nitin.
Okay. So it is still working. Actually, the reason I organized this workshop because I wanted to look for the partners who basically are interested in implementing it. Same point of time, I wanted to share my knowledge with my fellow colleagues in the banking sector, insurance sector, who basically want to explore the opportunity in this area.
Okay.
It's going to come in a sec. Going to come in a sec. Yes, Kim. So you will be able to see the contract data. So you see the contract data here. All the 800 contract you will see. 825. And this is my loss, this is my mortality, this is risk adjustment, this is return rate, this is asset return rate. I can see the classified also. I can classify this contract into three categories: profitable, non-profitable, and loss making. Normally, when you do the classification, you get mostly one is loss making. Profitable is basically who is not one. So that's the kind of thing it is. And then I have aggregated data where I will aggregate the profitable together, owners together, according to the portfolio. So if I look at this data, I have 400 contracts of this portfolio, 28 for this portfolio, which are owners, 397 which are profitable for this portfolio. So I can aggregate 400 contracts in this one line by aggregating the contract data. I can aggregate 28 contracts in this line. So this particular data which you have seen here is aggregated data. You click on here, perform IFRS 17 calculation. It will perform calculation for this. So this tool will take individual policies, group them together, do all the calculation for you. That's what this tool can do, which basically is a very big pain for insurance company, how to characterize into three categories like profitable, non-profitable, and owners. So this is for first 400, all the calculation. This is for next 28, all calculation. If you want to ask question, feel free, because I think people are not able to understand it and follow it. So it's better if you ask questions.
Okay, Nitin.
So this is for another 397 here. So this is what this tool does. It's a very
Okay.
good tool. It's very good tool. Only thing is look and feel is not that great, but tool is good.
So the basically idea is if we go with the premium, I mean insurance data, and by inserting that individual or raw data into this tool, then this tool will convert and create the
It will,
components.
it will
Components.
create it will create different components like bell, risk adjustment, and TSM, and it will calculate the life
So
LIC.
suppose now it is calculated whatever the components that we discussed, bell and risk adjustment and everything. So uh, in balance sheet, suppose I'm an insurance company, then how can I utilize this data and I can enter into my or uh, utilize this capability to get benefit out of it?
Sure. 1 minute. Let me show you a disclosure. Where is disclosure? The sheet I am showing is as a disclosure sheet, which
Mhm.
basically insurance company need to report to RBI or any other central organization in the country,
Central Bank of London.
Central Bank of London, or in Indonesia it will be Central Bank of Indonesia.
Yep.
So it will have profit of loss statement, which basically which we are already seeing here. This one.
Mhm.
So it will come here, everything. And then we will have a statement of financial position, and we will show the assets. Inside the assets, we will have these ones, total contract liability or total contract asset. So total
So here
contract,
we have a 20 years, I mean, estimation for next 20 years. So in financial statement or balance sheet, which component, I mean, total asset means which one I have to take it?
it will be like this.
Okay. Year one, two, three, okay. 10.
Year 1 to 10, it can be up to year 20.
So is your dashboard, whatever you build, it does has or it has the capability to insert these numbers automatically from the exercise that we did it?
I think what my tool does it basically show the values here
Hmm.
where it is. Today is 6, right? So it will be having value here.
Okay, it creates some CSV or Excel.
You get the CSVs here.
Mhm. So in one CSV generally gives us a one single tab, right? Uh, but in earlier Excel sheet, you have shown different models. I mean, different methods, GVV or some other
Yeah,
methods. So,
yeah. Let me show you something. Let me show you something very good. So I had done this calculation. I think so. Today is 7/6, right?
yeah.
At, okay, let me open one of these. So I had coverage unit, cash flow projection, liability or initial recognition, reconciliation. So I will have everything here in this one.
Hmm.
I will, but the challenge here is not this that I have this value. I have to merge everything which is profitable together, which means I will have feature of the tool here to merge the output which are profitable together.
Okay.
And then once they are merged, then I can take it to this Excel sheet and insert values here. We will have
Okay.
two values. One is this is my this date, this is my comparative date. Comparative date means I had to do it for 2 years. One for 2024, one for 2023. So this will be for 24, this is for 23.
So T minus one is the comparative date and
Yeah,
reporting date is T. Okay.
yes, yes. You got more understanding now?
Yeah, I got some better understanding.
So guys, I want to know whether you're following it. If you're not following, I'll stop this workshop here. Max, does it make sense to continue?
Yes, for me it yes, and you can take others'
Okay,
opinion as
okay. Let me continue then. So I was talking about discount rate. So discount rate is another thing where you're going to use the credit risk here. Credit risk means probability of default and loss which you make when you downgrade something from one grade to another grade. That kind of loss, unexpected loss. And you will subtract this from the yield curve, which is a return rate for the portfolio. And you will get the top-down approach is this. Bottom approach is you get the risk-free rate for the portfolio, either for a US bond or something else, or from the RBI bond, you'll get the risk-free rate, and you will add the illiquidity adjustment to that, and it will give a discount rate to you. Third block is what is the risk adjustment liability. Risk adjustment liability is a compensation which you will get for taking the risk about the amount and timing of the cash flow that arise from the insurance contract. It covers only non-financial risk. It does not cover the financial risk. Financial risk is related with any option, hedging, etc., which you hold when you basically hold the insurance contract. The fourth block is contractor service margin, CSM.
well.
Yeah.
We not able to see anything on our screen.
Sorry. I'm very sorry. I just get lost. It was sharing the screen actually. Now you can.
Yeah.
So go back. So yield curve is basically return on the portfolio minus expected credit loss and expected credit loss. On the other side, if you take the bottom up approach for the discount, it will be risk-free rate plus liquidity illiquidity adjustment. So next is what is risk adjustment. Risk adjustment is has to do with the bonus which you get for carrying the risk about the amount and timing of the insurance portfolio. It's non-financial risk, and it basically helps to diversify the risk which insurance company takes. Next is contractor service margin. Contractor service margin, I explained, is the profit, which basically you keep there, and you book the profit only once service is provided. So this is a brand new concept which basically has been introduced into IFRS 17.
Okay.
So let's look how CMS system basically is basically uh, works. So you have CSM in the beginning 100, and then new contract get added up here. After new contract get added up, it gets up to 140, and then interest accredited, it becomes 150, and then there is change in value of the future cash flow because of it drops by some amount, and then there's the impact of currency change because of that it goes up again, and then there is amortization of the CSM. Amortization of CSM is released to the profit and loss statement of balance sheet, some value of CSM for which you have provided the service, and balance is this one. Any question?
What is CSM?
Contribution service margin, contracted service margin. It's a profit which you will keep as a component. You will release only once the service is provided.
And we are reconciled against what? CSM is reconciled against.
If you look at this Excel, CSM is initial value is like
Okay, initial opening value, how much we have and how much we
that,
spend it.
that CSM which you get 17, 80, 30 will come here, and you will release some amount in first year, some amount in second year, some amount in third year, and throughout the life you provide the some value which basically is going to balance sheet or profit and loss statement in proportion of your contractor service margin. Is that okay?
That is okay, but I have one more doubt, Nitin. Can you please open the PPT that which you have shown?
Yeah.
So this is contractual service management, right? And you
Which
said
contractor service margin?
margin. And you said this is going to uh, release or start spending after
Service is provided.
services pro.
For instance, you have insurance policy and
Okay,
you have 20 years cash flow you have.
okay,
After calculating 20 years cash flow, all the expense taken care, everything, you see a profit of 100,000 euro is coming. So that profit you will not book in the profit and loss statement or balance sheet immediately. What you will do is you will assign it to CSM, contractual service margin. Contractual service
mhm,
margin will release it sequentially as the service is provided.
okay.
Yeah. So we had discussed four blocks
But
of,
I have one more question. So
yeah,
contractual service margin. Uh, so every year I have to showcase that in our balance sheet, right? But if uh, I mean, in Excel sheet, you are calculating for the next 20 years.
yes,
But suppose if I want to record it in my balance sheet for this year, then why should I calculate for the next 20 years
because you want to see what's worth.
for
Like
today?
you do the company valuation, right?
Yeah,
When you do the company valuation, you calculate the project value of the cash flows,
correct.
and then you see this is what today it is. This is the reason you go to put that into the profit and loss statement. But if you put everything together now, then what will happen? Your balance sheet will jump very high in the beginning, or profit or loss will jump very high in the beginning.
Got you. So
But
instead of that, we are calculating the present value for at this point, and we are recording that value
yeah,
in.
CSM, not in the profit and loss and balance sheet.
Okay.
Make sense?
Yeah, it makes sense.
Okay. So all these three are called fulfillment cash flow, and this is called insurance contract liability. Second approach is variable fee approach. With the variable fee approach, it's a modification of the general approach for valuing the insurance contract with the payment that vary with the return on the high underlying item. It's unit linked, it has to do with the profit, which means I will take a insurance contract where they will tell me that I'm going to invest your money into fund, and I will charge you a fee for that, and you will get the fair value out of the returns, which means if my commission is 5%, 95% you will get. This is what variable fee is all about. So I'm charging a variable fee to the customer, and customer is getting the return on his investment. Make sense?
Yeah, and I got one more question, Nitin. See, uh, uh, I worked in credit risk and market risk. So if you ask me why you are working in what is your objective by doing the calculation of PD, LGD, EAD models, then I can tell that at the end of the day, company will going to know how much amount that they has to keep aside to meet their losses from their bank operations, and if it is a trading operations, and if they want to keep certain amount aside, then I say using the risk metrics like VAR and some other, then we'll calculate. That is for the market risk. But here the job, I mean, even for the you just mentioned IFRS 17 workshop, but this whole exercise and these are all comes under which side, and what exact title should be suitable for this type of job? I mean, how can
This is more to do with actuary,
actually?
like
Okay,
what banking guys do, same thing actuary do. It means in banking you call accountant, in
okay,
insurance you call actuary. So actuary does this all calculation.
okay. Got
So
it now. Now
in
it
the,
make more sense.
yeah, variable fee basically it returns you profit, but here CSM calculation is same as general model in the beginning, but in the subsequent calculation there are different components because of variable fee. So it differs in calculation. Very difficult to implement because people are not expert in this approach. Generally, they go with GMM approach.
Okay.
So
Third
maybe,
one is
oh, sorry. Okay, you can finish, Nitin.
anybody?
No, I just wanted to add some more insights, probably some angle in terms of
Sure,
who
please.
or who or why this standard. So similar to like the gentleman was saying, credit risk, market risk, and all of the liquidity risk and currency risk or whatever, right? So basically, uh, there are in financial instruments, except insure, I mean, not for insurance, but for financial instruments, there seem to be parameters which are affecting the effect to the profit and loss or the balance sheet interchangeably. Sometimes you book more profit, or sometimes you defer profit and you kind of amortize in, or you recognize profit more earlier So there has been all these non-standard ways of uh, companies doing things, and like what Nitin was saying, that even though actuaries are involved in the way to standardize these calculations, but actually at the end of the day, it is a financial reporting and finance standard for recognizing income and uh, income in your P&L, and basically valuating your the assets value in terms of assets or liabilities, right? So in terms of what is the value of this financial asset or the instrument, whether it is, yeah. So that's typically end of, it boils down to only these two things. It's a zero sum game where in terms of some money comes from the balance sheet into P&L or P&L into asset and gets deferred over, I mean, and then amortized over a period of time. This typically, these are the operations which happen, right? These adjustments tend to do what means sometimes if you recognize more P&L this year, which is as per the standard is not right, you will have to defer them and amortize them, or other way around. Or sometimes you don't recognize them this year and they're kind of capitalized as assets, but in theory they don't seem to be really assets. They could be actually direct losses even this year itself, right? So people might be hiding losses as assets, and then they can defer that to the future, right? So all of those combinations will be coming up because of the standard is very straightforward. It gives you the clear rules in terms of how to measure these instruments, I mean these insurance contracts, and that's why you have the CSM and other things coming up, which clearly gives you the difference between IFRS 4 and 17. And that adjustments needs to be, if your contracts are measured in IFRS 4 in your core systems, the IFRS 17 adjustments need to be computed, and your booking should be booked in your general ledger, meaning your GL. Okay, that's I think overall the essence of it. But the nuances are always inside how the various approaches are telling us to do the. I mean, that's the actuarial part of it, because every insurance contract has an embedded risk and embedded profitability inside, and the actuarials have their own ways of evaluating, measuring them. That's overall. I think it's a high level, right? And I think then there is essence. Then there is diving into the individual components of every type of classifications of the contracts and how the treatment needs to be done for various others. It's the same thing in the financial instrument in the IFRS 9, but the only thing is this is an insurance contract. That's all.
Okay. Thanks for clear explanation, Manohar.
Yeah. Okay. Nitin, I think you're explaining in mute. Probably I'm not able to hear. I don't know about others.
Yeah, even I'm also. I
Sorry,
thought he was taking.
sorry. So there are two components of liability. One is the liability of incurred claim. Liability of incurred claim is it has to do with the past claim. Then there is liability for the remaining coverage. So I was telling you, you sum these three, BEL, RA, and CSM, you will reach to total liability. Same way, you sum these two, LIC and LRC, liability for remaining coverage. You should reach to total contract liability. So this is again IFRS 17 requirement. So what PA does it? It simplifies you LRC. which is liability for the remaining coverage. Are you following, Surya?
Yes, Nitin.
Okay. So it will simplify LRC and it will not have to calculate the risk adjustment or CSM for LRC. This is the kind of simplification which they have done for this. If you talk about standard, it's very similar in calculation with IFRS 4, but not exactly IFRS 4. Because for LIC, you need to follow the same approach, risk adjustment plus cash flow. So before we implement the PA, we have eligibility test. So one test is coverage period is less than 1 year. If it's less than 1 year, you will simply implement it. Second thing is your LRC, liability for remaining coverage, for PA approach, liability for remaining coverage for the GMM approach. They don't have much difference. If that is the case, you can apply this for the insurance contract, which is more than 1 year in duration or coverage. So they have recommended like you should implement the test in case you want to use the PA for contract less than 1 year. I would simplify it in a way that rather than doing this test, doing all the calculation again and again, you implement it for PA, which is for less than 1 year, and implement it for rest TMM approach. So if you compare this one, like I mentioned, liability for remaining coverage is simplified. This is very similar in nature to IFRS 4. This is IFRS 17, but liability for incurred claim, which is the past claim, it is exactly same thing. When you look at the different component, AC is acquisition cash flow, unearned premium reserve, building block approach, and cash flows. These are cash flows. Any question? This is very important to understand the difference between BA, BBA, and PA. So
Okay.
we can, yeah. So we can talk about reinsurance now. Reinsurance is inward reinsurance or outward reinsurance. Inward reinsurance is basically you have given insurance contract and you want to insure yourself against that risk that claim will come and wipe out all my profit. So you want to make sure that you have some inward insurance. So there are two approach for implementing that, BBA and PA. And you will have cash flow, which is probability weighted, which is unbiased, fulfillment cash flow. Same thing for this one, outward. You will have two approach, BBA or PA. Outward means somebody has taken some insurance company basically has given set of insurance contract and they were insuring by purchasing insurance from you. That's called outward reinsurance. So the insurance basically which you sell could be proportional reinsurance or it could be normal insurance. Proportional means if you basically have given a insurance liability of 100 million, you want to make sure that you cover 100 million by purchasing insurance from some other company. That's called proportional reinsurance. In the reinsurance, when you have inward reinsurance, CSM can be only positive at initial recognition and contract can be profitable, onerous or non-significant probability of being onerous, which is basically non-onerous. And outward, it could be positive or negative. So you need to look into this details when you basically start implementing the reinsurance contract liabilities or assets, depending upon whether it's profitable or non-profitable. So let's talk about transition. Transition is all about when you're moving towards IFRS 17 from IFRS 4. In India, at the moment, IFRS 17 implementation is in place. Company like Deloitte, EY, PwC, McKinsey, they are implementing IFRS 17. You can assume how much kind of investment which insurance company are making, that consulting company are getting involved. So when you talk about transition, transition means you will implement IFRS 17 as you have been always following IFRS 17. That's called fully retrospective approach. You have historical data. You have historical data, and hindsight is not required. Second case, when you don't have the historical data, but you can still have information about the historical cash flow, or it can be constructed. So if that is practical, then you use a modified retrospective approach. Third case, when you don't have historical cash flow, or it cannot be reconstructed, then you use the fair value approach. Fair value is more like a selling value of an insurance contract liability, insurance contract group. You want to sell this portfolio for this much amount. That becomes the fair value. Make sense?
Yes.
So let's look little bit about the presentation and disclosure. Shall we look or skip it? Because it will be complicated for you. Let's skip it.
Yeah.
So IFRS profit and loss statement look like this, and IFRS 17 looks like. It's more simplified, but it has more component. There's more lot of judgment needed. So eventually it will also be replaced. That's what I think, because there are a lot of judgments required in calculation. There are different approach for implementing different components like CSM, risk adjustment, and discount rate. So consistency is not there, but it's more simplified compared to IFRS 4. It's more fair to IFRS 4. So that's why it's used currently. One of the things which IFRS 17 uh, implement is present value, probability weighted cash flow. It implements risk adjustment for taking the risk. It implements contractual service margin for saving the profit, not releasing the profit immediately until the service is provided. And then it has liability for remaining coverage in PA. Then other thing which basically have been added into judgment method used to calculate the financial income. So all these reds are new things. All rest black are already there in the place in the IFRS 4. It also introduced the confidential intervals, basically for different calculations. For instance, for if you are going to calculate the risk adjustment, it will talk about confidential interval. So impact of IFRS 17 are on business. You need to teach investors. You need to basically explain why profits are coming, how they are coming, and you need to design new products. You need to do lot of planning, lot of budgeting. Operationally, there is a risk that you will have incorrect or inaccurate information because it's very complicated. It will be very difficult for IT to understand this until unless they are guided by somebody from the actuary background or accounting background. System has to be changed because currently there is a requirement that you should have software for the IFRS 17, which basically costs in millions. So that's the kind of system requirement basically has come up with IFRS 17. So these are the steps which basically need to follow to get it organized. So you will have impact assessment, project planning, gather and validate data, implement system and process, dry run and compatibility, comparison. During the assessment, you need to follow the step like training, gap analysis, system impact analysis, financial impact analysis, all this. So it's not easy task to implement IFRS 17, but you have to implement it in case you're running an insurance company. So we will deep dive into GMM approach now. So, so we had talked about three different approach GMM model. It's a default approach for most of the insurance company, and it's used in the production for life insurance, general insurance. It's called building block approach. Variable fee approach is basically where investment component is involved. Insurance policy money is invested in the stocks, a mutual fund, hedge fund, options, etc., where you can get some return for your customer. Premium allocation approach is used mostly for 1 year, less than 1 year contract. So, which product it applies to? It will apply for life insurance, term insurance, product insurance, annuities, reinsurance, multi-year motor, warranty cover, certain kind of loss, unit link, variable annuity, continental. So all these are product types which basically it will be applied for. Any question at this point?
Nitin, frankly, since I mean, been I've been from finance background only and working in a risk domain only. But since I do not have hands-on experience, I'm not able to digest it immediately. But the
Okay.
reason I joined in this workshop, like I want to understand where can I apply, I mean, utilize this knowledge in my. But after attending the 1.5 or 2 hours session, uh, I say that what I work and here I'm learning there's bit different. But I understand your. I have few basic questions before asking some other questions. How long have you been working in this industry?
I'm working in credit risk for a long time since 2008. But in this particular one, I'm working since last 1 year.
Okay, actuarials. So have you completed the actuarials or have you written any certification course for that?
My focus was to build the product.
Okay.
I have built the product, which basically could be used for IFRS 17 software implementation purpose.
Okay. Even I do in my current job or even in my previous work also, I have implemented similar kind of dashboards and similar kind of tools. And currently I'm working in for the ING bank and as a data engineer. So after in our conversation, I mean, in last from 2 hours conversation, I understand that you are looking for a candidate that who can support or who align the same kind of mindset. Do you want to work with them, or what is that objective?
My objective was to give training. More than 25 people have signed up,
Uh-huh.
and I was expecting like people will take training like they took the training for the scorecard, and I got more than 60 registrations for that.
Okay, okay, okay.
So I have same objective like teach people IFRS 17. Somebody want to take job in IFRS 17, they can go ahead and take the job based on the knowledge they get. But
Okay.
what I realized it like people are not interested in taking this workshop anymore. So what
No, no, no.
are
It's not about not interested. Since I'm saying from my side, I'm not working in this area. So whatever you are saying, that I'm not able to take it or understand it immediately. But if I start focusing on learning that how to work on this income statements or balance sheets, then I can understand. I mean, more.
you work for Crystal, right?
Yeah, I work for Crystal.
Does Crystal work on insurance sector?
Currently, it is not. Maybe some other people work because, as per my knowledge, I also closely monitor that what other teams also do. Majority, I know market risk and credit risk, and we are also offering the software solution services, etc. But not insurance. I One or two guys are from actuals and they work, but I don't know for which bank they are working, or I do not have much
My
details.
question, are they interested in going into insurance sector? Because I can help.
Okay, okay, got
So
it.
that way I can help, and I can train your team, and they can go into the insurance sector, and we can work in a partnership because I had team here.
Okay. Then, if that is the case, then let me speak with my manager on this. Can you please send me that what is your expertise area and what topics that you are going to give the training, and how do you pitch in new companies? I mean, if you have an exposure experience earlier, then if you provide these details, then definitely I can uh,
If you
take it
go,
to the management and in uh, I mean people in UK, then they can discuss with you. And
we can discuss in India also because implementation is happening in India.
okay, okay.
So I'm going to cover. I have 141 slides
Mm-hmm.
and GMM approach, PA approach, VF approach. The three approaches are implemented. That's what I want to cover. I know them in and out.
Okay,
Okay.
okay. So have
So
you worked with Crisil before?
yes,
Okay, as a credit risk
yes, I have
model
worked.
developer,
Yeah, I
validator.
work with the credit risk as a